as the Chief Investment Officer, providing global investment strategy.
Using an ETF can, and a lot of times, be better than a mutual fund for new money.
And a weaker dollar could certainly provide more of a tailwind for foreign markets that we've been lacking for several years.
So you can be rewarded if you can pick the good ones versus just owning all of them.
That's absolutely right.
Yeah. Okay, so welcome back. This is episode 256. This week I'm joined by Michael Sheldon. Welcome, Michael.
Thank you for having me.
Yeah, it's great for you to be here. For those that are listening, we're actually doing this episode in person. Normally we do it over Zoom, but Michael lives close and we have the opportunity to get together, so we're taking advantage of that. And so a little bit of background on Michael. Michael has a number of financial designations. He has over 26 years of experience in the financial services field. He holds a CFA credential, CFP, and FRM designation. And this week he's here to talk about investing in retirement. So Michael, tell us a little bit about your background. You know, what have you been doing in the financial field? How'd you get into this?
Sure. Thanks again very much for having me. So I'll go back a little bit of a ways. I started off many moons ago at the Bank of Tokyo, Mitsubishi. That was when Japan was taking over the world in the late 1980s. Okay. And I worked there for about 10 years. I was involved in trading and sales, and I worked in the bank's pension department for Japanese companies that invested in the United States. From there, I moved on to institutional fixed income sales, where I was at a broker-dealer in New York City for several years, dealing with institutional investors, insurance companies, states, pension funds, endowments. And then from there, I moved on to more of a strategy role. I worked at Spencer Clark for the next 8 years, where I was the chief market strategist. That firm had about 150 brokers, so I was involved in providing global investment strategy, market data, thought leadership. I also met with the advisors as well as their clients to help generate business and deal with portfolio management. From there, we had a daughter, and we were living in New York City at the time, and we had an opportunity to move out to Connecticut. So I moved to RDM Financial Group in 2008. I was a broker-dealer, a sort of a wealth management firm.
Sure.
And so they're based in Westport, Connecticut, with an office in Florida. And I've been the chief investment officer there, so basically from 2008 to 2024. There was 1 year where I left to join a team of advisors, which is where we met.
That's right,
at LPL in West Hartford, Connecticut. But aside from that year, I was with RDM Financial from 2008 to 2024. And my role there was mainly as the chief investment officer, providing global investment strategy, constructing multi-asset portfolios and implementing those, dealing with doing research on public and private investments. I also did thought leadership, providing market newsletters, media coverage. I also attended a number of client meetings, both with existing and prospective clients, sort of helping them understand our investment philosophy, going over portfolio reviews, answering a wide range of questions, and so that's sort of a little bit of background.
Okay, sure. So you've been a busy guy. You've been doing a lot. So as far as I said, we wanted to talk about, investing for really, like, as the focus of this podcast is for pre-retirees and retirees, people over 50. So, what do you think is best for someone in that position as far as how they should approach investing? I know that's a big question to answer.
Well, I think from our perspective, from you and I, thinking about us as working in this industry, our main goal is to help clients at whatever age basically achieve their long-term investment goals, whatever they may be. So I think a good place to start when you're working with clients, at least at my old firm, is we started with a financial plan. So clients would come in and we talk about creating a financial plan, and the first step in that process is to fill out a budget. And that can be
Sure.
a sort of an annoying, cumbersome project, but it also is enlightening in some ways. And then once you create a financial plan,
Sure.
that helps determine the rate of return that you need in order to meet your long-term investment goals. And then as part of that process, you can figure out what type of model you should be in, whether you should be aggressive, conservative, and what the allocation should be, whether you should be 80% equities, 20% fixed income, things of that nature.
Yeah, definitely the budgeting process. That's something that we have all clients go through, and I do get that feedback that, I didn't have a budget. I kind of knew what I was spending my money on, but it wasn't something that was really defined. So I think that's a great point that people understand, what their expenses are in retirement, because now you've got, you're retired, you don't have a paycheck coming in, so you really need to have an idea of what you need on a monthly basis.
Right. And I think as people as people sort of get older, they start off investing in 401ks when they're younger. They can be much more aggressive. If they make a mistake in their portfolios, they have a lot of time to correct that. But as you get into your 30s, 40s, 50s, and 60s, I think ultimately people become a little more conservative because if something was to go wrong in the portfolio, you don't have as many years to correct that. And so when you're younger, generally you tend to have more aggressive portfolios, maybe 80-20, 70-30, even 100% equity when you're much younger. Sure. And then as you become older and move towards retirement, you get a little more conservative. Maybe you add some dividend-paying stocks, other income-related stocks. So that's sort of the tendency and the trends that we've seen in this industry.
Do you ever see, people that are retired have like a very large, equity portfolio? I mean, do you think that's appropriate if somebody said, I really love stocks, I want to be 100% in stocks when I'm in my 60s?
Yeah, I mean, every person's a little bit different. So there could be people who are still working in their 60s and contributing to a 401k, for example. But people can be aggressive. People are living, one important thing is, as you probably know, people are living longer than they used to.
Yeah.
So they need to be able to have assets that continue to grow over time. And it partly depends on the risk tolerance level of clients, but also how much they have in assets that can support them as they move towards retirement and in retirement.
Sure. Yeah. I mean, generally, I try to have clients position about 3 to 5 years of living expenses in like cash or short-term bonds as they get closer to retiring in case they go through a major market decline, right? But that's not, you don't have to do that necessarily. If you were okay with a lot of volatility, you could just leave it all in the stock market potentially, right?
Yeah, I think the other thing is that, you live through this every day with your clients, that markets are going to have their ups and downs over time, of course.
Yeah.
The last few weeks have certainly proven that with the tariff news and Trump. So, I mean, the thing to think about is every year on average, you have about 3 to 4 pullbacks, which are declines of about 5 to 10% in the market.
Sure.
About on average, once a year, you have a correction of about 10% or more. And then on average, every 3 to 4 years, you have a bear market. Those are the ones which, unfortunately, can do more damage and create more angst among clients over time. So I think the way we thought about it is you put together a financial plan and you put together the appropriate asset allocation so you can ride out those ups and downs which are inevitable in the market over time to help you stay in the market at the worst possible times so that you can ultimately meet your long-term investment goals. That's
right. Yeah, you don't want to be getting out of the market when the market's bottoming, right? I have some visuals on the wall here, right? You don't want to be buying high and selling low, right?
We had a couple of clients who would often call in like at the worst possible time,
Sure.
And they would say, "Get me out," and that was typically a sign that we were close to a bottom.
That's right. Yes. Yeah. I mean, when you do have a lot of people that want to get out, probably a lot of people are feeling that way, or even a few clients. It's indicative of the overall sentiment. So as the selling exhausts itself, right, we hit the bottom. But you don't know until after it's happened that we've hit the bottom.
Right. And I think an important thing that we thought about is diversification. You don't want to have all your eggs in one basket.
Sure.
I think if you look back over the last 15 years ago or so, the best things you could have done were to be overweight the U.S. versus foreign markets, overweight growth versus value, and overweight large cap versus small cap. But sort of if you think of a ship, for example, when all the people on the ship move to one side of the ship, it becomes a little more unwieldy, and the risks increase. That the boat tips a little bit over to one side, everybody could fall off. So you just have to have some. We always preach that you want to have diversification in your portfolio. We thought of our goal at our last firm was to sort of think of clients sort of hitting singles and doubles as opposed to triples and home runs. Clients came to us because they were successful in life, and it was our job to sort of protect that and help their assets grow over time, again, to meet their long-term investment goals.
No, I love that analogy, the hitting singles and doubles. I use that a lot because a lot of times people are looking for that home run. They're like looking for the next Apple or NVIDIA. And even younger people, they think they need to find that to create wealth, but really they don't. They just need consistent growth and not have major losses that are unrecoverable from.
Yeah, we often had clients that had play accounts. And in the play accounts, we'd provide advice on certain stocks or sectors,
Sure.
areas of the market that we thought looked attractive and could provide some capital appreciation. But that was sort of separate from the regular part of the portfolio, which basically was targeting the asset allocation and the investments that we put together in models.
Sure. Yeah, so definitely, having that asset allocation is a key component. But I want to go back to something you said before about in the last 15 years, if ideally you were all large cap growth, right? In U.S. In centric, you did really well. Mm-hmm. But what do you think about, small cap, for example, versus large cap? Do you think that's something that maybe offers opportunity in the next 5 to 10 years? Or do you think large cap, the mega companies will continue to dominate the market?
Yeah, it's a really interesting conversation right now. These types of things, I think, go in cycles. And typically you want to buy, for example, high yield or small caps when you're coming out of a recession, when data is really depressed.
Sure.
And small cap stocks have more leverage, they have more risk, they don't have the balance sheets to fall back on that large cap stocks have. So coming out of a recession is really when small caps sort of have their best get up and go. And we're not really coming out of a recession right now. We also have interest rates which are higher than they have been over the past several years. So I think unless the Fed starts to lower interest rates or we start to see some better economic data and investors feel more confident, it's going to be hard for small cap stocks to really become market leaders over the near term. But in terms of these different market cycles, I brought this one stat I wanted to share with you.
Sure, yeah.
Because many investors have correctly been overweight the U.S. over the past 15 years or so.
Yeah.
Even though it's always good to have some diversification because you never know which asset class is going to do best in any one year. But if you look back to, say, 1987, which I think is the farthest this goes back, the U.S., in 1987, the U.S. represented 30% of the MSCI All-Country World Index, which is basically all the countries in the world, both developed markets and emerging markets.
Sure.
So that was in 1987. Today, the U.S. represents 65% of the All-Country World Index.
Okay.
So the U.S. role in portfolios around the world has dramatically increased by more than 100%, and it's never been higher. So it's not to say the U.S. can't continue to do really well,
Sure.
but there may be some opportunities outside the U.S. For investors who are a little more flexible, and we just need some catalysts for that.
Yeah. I mean, there's been a lot of difficulty for international markets. I mean, there's been a lot of wars and I don't know, economically maybe their economies have struggled more than ours have. So yes, international has really hurt a lot of portfolios. You'd think you'd be doing the right thing. You have a diversified portfolio, but the more international you've had, the lower your returns have been.
Yeah, basically since about 2010, 2011, the less foreign you had, the better.
That's right. I mean, some companies more, like Vanguard, for example, and their target date funds, they seem to have a lot heavier international weighting than some other target date funds. Mm-hmm. So it really depends how you've been investing. But maybe the next 10 years offer better international returns than domestic.
Yeah, I think there's an opportunity for a foreign. I think for a few things are starting to maybe come together. Valuation levels have been cheap for a while, both on an absolute and a relative basis for foreign markets versus the U.S. So that hasn't been enough of a catalyst, although that's still sort of in the background. Dividend yields are higher overseas. You're having Germany now finally spend some money to help their economy. And I think also one key catalyst could be the dollar. So typically there's an inverse correlation between especially emerging markets and the U.S. and then, between emerging markets and the dollar. But also a weaker dollar helps foreign markets as well. So I think because of debt and deficits, maybe it does look like the U.S. dollar has started to decline. It's hard to say whether that's the beginning of a sustained decline, but it is a very real possibility. And a weaker dollar could certainly provide more of a tailwind for foreign markets that we've been lacking for several years.
Sure. Yeah. Regarding U.S. markets, something I read, I might be getting the stat wrong, that you take the value of some of the largest stocks in the U.S. and they're bigger than the entire stock market in some countries. Just one stock. Because some of our biggest stocks are massive valuations.
Yeah, I've heard that as well.
Yeah.
It just speaks to the fact of the market concentration that we've seen. So it's hard to imagine that the big seven, so to speak, are going to continue to grow over the next 10 to 20 years as they have over the past 10 years.
Sure.
I mean, they're really well positioned. They have great balance sheets. But the law of averages says that as your revenues continue to grow, that they're not quite going to grow at the same rate they have in the past.
Sure. Yeah, I mean, you take like Apple, how many more iPhones can people buy, right? How many more things can they sell to us to give them the growth going forward that they've had in the past?
Yeah. I wanted to go back to something you were talking about earlier, just briefly mentioned, was target date funds.
Oh, sure.
Which is kind of interesting. So we've looked at those in the past, and we never really incorporated those in our portfolios. I'm not sure about yourself. Target date funds can be very helpful. And for example, if you're retiring in 2060, that's the target.
That's right.
And
the year in the fund, corresponds to the target retirement date when you see that in there.
Right, and then the period between today and say 2060 in this example would be the glide path.
Sure.
So what I've found is that the fees can be a little bit on the higher side. I read recently that the average fee for a target date fund is 65 basis points,
okay,
or 0.65%.
Yeah.
So that means there are certainly some that are lower than that, but there's some that are higher than that. So you could construct a portfolio of index funds and ETFs that basically could be less expensive, and that would be money in the pocket of investors.
Sure.
And then also you have to look at the amount of equity and fixed income exposure over time, because there can be quite a variation among the different providers.
That's right. The glide path is essentially like the mix of stocks and bonds, and it changes like every year or so to get more conservative, so more in bonds and cash as you get closer to your retirement date. But that might not be right for you, as we talked about earlier on. Maybe you're a more conservative investor and you want more in bonds, or you're more aggressive and want more in stocks.
And you also can't really control how much foreign you have, or what the fixed income makeup is, because that's controlled by the providers themselves.
That's right. Additionally, I've seen too, like some will have, as we said earlier, a large international exposure, but also on like real estate. Some have like exposure to real estate investment trusts, others don't. Some have like a commodity exposure, others don't. Mm-hmm. So if you want or don't want those assets in your portfolio, you might not be, having them or not having them, depending on what you want.
Right. Another interesting question I was thinking maybe we'd talk about was dividend stocks in your portfolio.
Sure. Yeah. So I would say, and maybe you've seen this at your other firm, that people think, all right, I'm getting into retirement or close to retirement. I need income, so I should buy all dividend stocks. That's what I should own in my portfolio. What would you say to that?
Well, I'd say taken to its extreme, that can really cause problems. The only reason I say that is if you get into dividend-paying stocks and you want the highest income, so say you're looking at the average yield of the S&P 500, I believe, is around 1.4% or so.
Sure.
But if you get into stocks that yield, say, 5, 6, 7%, those could potentially be red flags. And those could be companies with weaker balance sheets. They could be in industries that are having trouble. It could be companies going through structural change.
Yeah.
So having the highest dividend yields is probably not the best idea. There are some options in things like REITs or MLPs, which can be positive for portfolios.
Sure.
But I think the way to think about it is really to look at companies that have maybe somewhat lower dividend yields, but have had a solid track record of continuing to raise their dividend over time. These companies are generating enough free cash flow that they can use that cash to either buy other companies, to do buybacks, but also increase their dividends. And so a company that has a dividend yield, say, 1, 2, 3%, those are the ones that probably present the best opportunities for both growth and income. And I always kind of thought about it that when companies are raising their dividend, that's a signal from management. They're not likely to lower their dividend unless you go through a major downturn.
Sure.
So raising their dividend over time is a positive sign from management that business is actually doing okay.
Yeah, and when you talk about like a company with like a 5 or 6% dividend, sometimes it could be a company that's on the brink of disaster because the dividend is so high it becomes unsustainable for the company to keep paying it. And then either they have to cut the dividend and when they do that, that's catastrophic to the stock. So they don't really want to cut the dividend usually, right?
Yeah, that could be a major problem.
Yeah.
And the stocks will probably react before the company cuts the dividend.
Yeah. And then additionally, sometimes just stocks with a high dividend don't really grow. So yes, you're getting the dividend, but you're not seeing the value of the stock really appreciate.
You're really just getting your money back.
That's right.
People don't really see that all the time.
Yeah. And so, I agree. I think looking at companies that have a lower dividend, that are growing their dividend and growing their earnings is really important, because as a retiree, what are you really after? You're after an income that can keep pace with inflation. And you could start out where your income's looking really good with high dividend paying stocks, but then if that doesn't increase or the value of those stocks go down, you've really done the opposite of what you're trying to do.
Another opportunity for some clients, and it's really a case-by-case basis, is private investments, but it's not for everybody.
Okay, talk a little bit more about that.
So private investments, it used to be that you had to be what's called a qualified investor, where you had to have a significant amount of money in order to purchase these. And typically they involved a K1, which the accountants didn't like,
sure.
And you had a 10-year hold, and money was taken by the investment fund over a period of time. So they would draw the money down, significant sum of the money over 1 year, the next maybe another 6 months from then. So there were a lot of challenges in just trying to follow and track and understand these. More recently, the industry has sort of changed towards what's called evergreen funds or perpetual funds, where all the money gets invested at once, and you get a 1099 instead of a K1. And instead of the fund ending in 10 years, it continues over time. The minimums are also typically lower. So these are, you can get these, the typical sort of subsegments within private investments are things like private real estate, private credit, private equity, hedge funds, and infrastructure.
Sure.
So it's not really for everybody, but they do serve certain needs if you're looking for income, non-correlating assets, if you're looking for growth. So it's sort of really is a case-by-case basis, knowing the clients and understanding each of these investments.
Sure.
But they're another thing to maybe look at for some clients.
Yeah, and so they must have like a quarterly redemption, maybe, right? You can, if you want your money out, or monthly, they allow a certain amount of redemptions in the fund, right?
For the private credit, for example, there's you can earn somewhere in, like, depending on the investment, in the 8 to 10% range, but you're giving up some liquidity.
Oh, sure.
So that's a big deal.
Yeah.
So typically, a lot of these funds offer to redeem about 5% of all the assets that are out there on a quarterly basis. But if all the investors want to get their money out at the same time, not everybody's going to be able to get their 5% out. So that illiquidity is really important for our clients to know about.
Yeah, I did some investing for clients in private REITs years ago, and I probably did 8 or 9 of them, and a couple of them worked out, but the majority of them really didn't. And then that illiquidity is a problem because the value of the fund went down and no one can get their money out because they stopped redemptions essentially.
Yeah, Blackstone, Starwood, and some of the other REITs had issues with that over the last several years or so. They had really good years coming out of COVID.
Sure.
And but then they had a couple of down years, and I think they're starting to turn around again. But they can have their ups and downs.
Yeah. You mentioned real estate. Do you think that's a good idea as another way to diversify the portfolio, to potentially add or maybe even a publicly traded real estate investment trust fund?
Yeah, some of the data, if you look back over time, if you look at commercial real estate data, it shows a couple of good things. It shows that historically it's provided pretty steady returns, and it's also provided a hedge against inflation. So especially coming out of COVID, when inflation shot up to over 9%, it's since come down quite a bit, although it's not down to where it was pre-COVID. Real estate can provide a pretty good hedge against inflation. There are often interest rate riders in there, inflation riders in there, so prices can increase about 2% per year, depending on the contracts and all that.
Sure.
So, but there are different types of real estate. Residential real estate. There's office. There's healthcare. The one that got into real trouble was commercial real estate.
Sure.
And also the office malls.
During COVID,
the malls,
nobody wanted to go anywhere, right? So, Those really took a beating, and if you were courageous enough to buy them, when things were really bad, you could have done really well. But we didn't know if we were ever leaving our houses again during that time.
Yeah, so I think there are opportunities in real estate. Again, there are opportunities in private real estate, but also some of the REITs. But you have to do your homework.
Sure. Yeah, and it's also volatile. It's not like you buy your home and you don't really think about the price until you're ready to sell it. I mean, you might go on Zillow and look at your house all the time, but most people don't. Whereas when you buy a real estate investment trust, you're seeing every day what it's worth.
Yeah, I think there are two aspects of that. The private REITs only price usually on a monthly or quarterly basis, so you don't have as much volatility, underlying volatility.
Sure.
But if you buy public REITs, they're just like any other stock.
Yeah.
And even though the assets themselves don't necessarily go up or down on a daily basis, the stocks can. So that can create a significant amount of volatility within client portfolios.
Yeah, definitely. And so it's something you have to decide if you want to add it, but it's another way to diversify and create income.
Yeah, it's an income provider like some of the others, like MLPs, for example.
Yeah, so talk a little bit about MLPs. What are those?
MLPs are master limited partnerships. So they're typically companies that send energy, oil, gas liquids around the country.
Okay.
And they basically create long-term contracts, typically 10 years plus. There are inflation riders in there, which which reset on a yearly basis, so the fees that they're generating go up over time. And the idea there is that they provide long-term sort of energy exposure, and the yields are attractive. That's one of the things that attracts people to them. So there are a couple of different kinds, which is important from a tax perspective that clients need to do their homework on. There's some which are sort of traditional corporations where you're taxed like dividends, and there are others where there are MLPs where you have something called return of capital, and that's from a tax perspective, that's very important. So you're not necessarily taxed immediately, but there's a return of there's a dividend recapture when you go to sell it.
Okay.
So that's something investors need to do their homework on. But it's another area that the other thing to consider for those is historically the correlation between MLPs and energy prices has fluctuated. So because these are typically long-term contracts and companies, who have locked in rates for many years, they shouldn't necessarily follow the track of oil prices or gas prices, but sometimes they do.
Okay. Yeah, so there could be some volatility there. Maybe something like that is better off in an IRA, and then you don't have to deal with the K1 or the dividend recapture.
Well, one important thing, though, is MLPs can throw off what's called UBTI.
Okay.
And so if the UBTI is more than, I believe it's $1,000, then you could actually have your retirement account taxed.
Oh, interesting.
So you have to be very careful about that.
Sure.
So they're probably not best.
Yeah. Oh, maybe
you have to
not.
be wary about that.
So you got to really know what you're doing before you get into that.
Yeah, I think so.
Yeah. So we touched a little bit earlier about active versus passive. So just for anybody that doesn't understand, as an investor, if we take the S&P 500 for example, right? That's an index of the 500 largest stocks in the U.S. So you could just buy that index, and now you have exposure to all those stocks, and you'll follow that index. Or you could look at the S&P 500 and say, okay, I want to pick out the 30 stocks in that index that I think are going to do the best over the next 5 years. And that's what active management is, right? Trying to select that. So talk a little bit about your experience with active versus passive, where you see that fitting into the portfolio for a retiree.
Sure. Over the last 20 years or so, it's been very difficult to beat the S&P 500.
So meaning pick a handful or however many stocks that did better than the index, right?
Right. For example, over the last 20 years, the S&P 500 has returned, I believe it's on a total return basis, including dividends, 10.3% per year.
Sure.
Just for reference, the international markets, or the EFA index, is up about 6% per year, and the emerging markets index is up just a little bit more than that. So I think from an investment perspective, if you buy the S&P 500, it's a constantly changing animal. There are always companies that are acquired, get kicked out, or
Sure.
companies that get too small or have problems get kicked out, and more innovative, faster growing companies get added to the index. So that's one of the reasons it's done very well. And our thinking was that you want to have some exposure to passive, which have lower fees, and have done a tremendous job of generating capital appreciation. But we also think there's a place for active management as well. So it is difficult for active mutual fund managers to beat the index.
Sure.
There have been a few over time, and for people who are willing to do their homework, I think that provides some additional diversification in different areas, whether it's large cap growth or small cap value, international small cap, emerging markets. Certain areas, you're probably better off with. You're actually better off with international. You're better off with an active portfolio.
Yeah.
For example, in international and emerging markets, and maybe in small caps.
Yeah, maybe because there's just more unprofitable companies in those areas, I've heard, or it's just more, I don't know, there's more dispersion with like good and bad companies, so you can be rewarded if you can pick the good ones versus just owning all of them.
That's absolutely right.
Yeah.
So
Go ahead.
So I think there's a place for both.
Yeah. So how do you think if somebody wants to go and find like good active funds that have the potential to beat the market over the next 5-10 years, how would you recommend somebody do that?
Well, there are different services that we use internally. For example, Morningstar is a great resource. Individuals can get a subscription to that if they want to, and you could do your homework. There are a lot of different sort of things to look at. There are a lot of different metrics that you look at. We like to look at companies that have outperformed their peer group over multiple time periods, say 1, 3, 5, and 10 years.
Sure.
That show some consistency. We like to look at the management team. Have there been a lot of changes, or have they been pretty consistent? Does the fund stay in its style box? Meaning, if it's a large cap value manager, does it stay as a large cap, or does it switch over to a blend or a growth over time?
Yeah.
If it's a large cap manager, do they stay in large cap, or do they also start buying small and mid cap stocks?
Sure.
We like to look at the volatility of the fund, how many stocks are in the fund. If it's too concentrated, that can create some risks. How much turnover is involved there? One of the other trends I think that's interesting is there's been a big increase in the number of ETFs that have been offered. And
Active ETFs, you mean?
First it was passive,
Sure.
now it's shifting to active.
Yeah.
So a lot of mutual funds are sort of loath to switch over their mutual funds to ETFs because they'll have lower fees, and they're sort of competing with the mutual fund. But
Yeah.
I think that's the trend we're going towards, that ultimately ETFs will replace mutual funds. It's not going to happen overnight. But I think there's been a lot more in the way of active ETFs, and I think that's an attractive area, especially because then you don't have to deal with the capital gains issue and taxes that mutual funds have at the end of the year.
That's right. Yeah, I agree. I think the mutual fund companies are realizing if they don't switch over to the ETFs, they're really missing out on additional assets they could be getting, even though it might lower their fee, because it does seem like the active fund ETFs have a lower ongoing management fee than the mutual fund versions of the similar funds.
Yeah, I think there are generally three positives for ETFs versus mutual funds. One is generally they're lower fees, although not in every situation, but generally. Two is you can trade ETFs like stocks, so you don't have to wait till the end of the day like you do for mutual funds.
Yeah.
And then there's the tax issue where some mutual funds have capital gains they pay out at the end of the year, which you have to sort of figure out what to do with, whereas ETFs generally, but not always, are able to wash out the taxes, so you don't have to worry about them.
Yeah, definitely. If you have taxable money outside of retirement accounts that you're investing, using an ETF can, and a lot of times, be better than a mutual fund for new money. For old money, sometimes you're stuck in that fund. You might have bought it long ago.
Right.
It's done well, and you'd have to pay the capital gain to switch out of it. You just have to kind of deal with it, maybe slowly liquidate it over time to get out of it.
You've probably had a situation where you have a new client who comes in, and instead of bringing cash, they have their investments.
That's right.
And they have capital gains embedded in those, and you can't just basically sell everything. So you have to sort of work around that and position that and add the other investments that you have in your model to that.
Definitely, yeah. We always have to keep an eye on taxes, for a new client. I mean, I'm sure there's some advisors that just sell everything and let the client deal with it, but that's not the right way to do it. You're trying to minimize your client's taxes wherever you can, and especially if somebody's retiring, they're probably in a lower tax bracket, so that's usually a better time to think about selling investments that have a long-term capital gain.
Right.
Yeah. So, as far as we shift a little bit to talking about, we talked a little bit about income, but, what do you think is best for people that are going into retirement? They're looking for income from their portfolio. From your experience, what's the best way to structure that or take that?
Well, I think there are a couple of things to think about. As you go from your 30s to 40s into your 50s to 60s, a common question we had was, should we make changes in our portfolios? And one question to think about is just having less volatility over time in your portfolio. So dividend-paying stocks have less volatility than non-dividend-paying stocks historically. Bonds historically have had less volatility than individual stocks. So there are some changes that you can make within the portfolio to sort of reduce the amount of volatility. Going from for example, if you go from, I was doing some work a few weeks ago, if you look at a 60-40 portfolio, for example, the volatility of that is about 12. So that's based on
standard deviation. Yeah.
So that may be a little too much math, but essentially standard deviation is the amount of volatility versus the mean, versus the average.
So if the average was 10, then like one standard deviation is plus or minus 12%. So a positive return of 22% or a negative return of 2%, right?
Right.
But so usually they say to go to 2 standard deviations, right, to capture the majority of the returns. Is that true, or?
2 will capture most of it, and then 3 will capture almost all of it.
That's right.
So what I was going to mention is that if you have a 60-40 portfolio, then it might have a standard deviation of about 12. So one way to think about it is if you wanted to reduce the standard deviation of your portfolio by, say, 25% to 9 from 12, you'd have to figure out what assets. It's sort of like a jigsaw puzzle.
Yeah.
Which assets you need to change. So you could make it, you could change it to 40, 50, 10, for example, 40 equity, 50 fixed income, 10%. Those are some of the things to think about as you're moving towards retirement.
What would be the other 10%?
And that 10% in that situation could be short-term cash.
Okay. All right. Yeah.
Depending on the amount of risk that the client's trying to reduce.
Yeah, and I think that's where we were talking earlier about.
Sorry.
Oh, no, it's okay. Knowing what your portfolio is. Like, I meet with a lot of prospective clients, and some of them will even tell me, "Oh, I'm a conservative investor," and then we'll do their asset allocation, and it's like 85% stocks. Well, that's not really conservative, and that's okay if that's where you want to be. But I think the first step is knowing your asset allocation, and then making a conscious decision that you want that to be your allocation going forward, whether that be closer to retirement, in retirement. And so you understand, like you said, the standard deviation to know what the best and worst case is. Because you don't want to be surprised the markets go down and then you want to get out at the bottom and you're really going to hurt yourself big time.
Yeah, clients may have a different opinion of their risk levels than you would think having a conversation with them. And ultimately, it's when the markets have a hiccup.
Yeah.
That's when you determine whether they feel they have the appropriate asset allocation and then whether they're taking on too much risk or not enough risk.
Sure. Now, you mentioned earlier that you've been doing some writing for, I think you said Barron's and TheStreet.com.
Yeah.
And the recent article that you wrote was how to reduce risk in portfolios. Talk a little bit about that.
Sure. So that was a Barron's article that I wrote recently. And so there are a couple of different ways to sort of think about, there are many different ways to think about reducing risk, but in this article I talked about a few ways. So one of them, and this is given the backdrop that we've had for the markets over the past few weeks. That's what sort of led me to think about this. So because of things like market events like Brexit, COVID, the tax issues that we've had recently,
sure.
Long-term credit, problems with Greece potentially falling out of the European Union, a debt downgrade in 2011 in the U.S. These types of things create volatility from time to time. So it's always worth having a conversation with clients and thinking about how you could reduce risk. So one of the ways we were just talking about a little bit earlier is looking at the standard deviation or volatility in your portfolio. So again, if you have a 60-40 portfolio with 60% equity, 40% fixed income, that would be a standard deviation of roughly 12. And if you wanted to reduce that by, say, a quarter down to 9 from 12, you'd have to figure out what changes to make. Another one is we had some success working with buffered ETFs This is a fairly new product that's been in the market over the last few years. And buffered ETFs basically allow you to, they're set up usually with a 1-year maturity. They can differ a little bit. And they basically allow you to capture a certain amount of the upside, and they'll typically protect a certain amount of the downside.
Okay.
So you might capture something like 12% or 15% in a given year, and on the downside, you might be protected for the first 8%, 15%, or 30%, and after that, you'll have to eat the rest of that.
Sure.
So there's some positives and negatives for these buffered ETFs. Initially, there was a liquidity issue, but there are now several different providers out there. The fees can be a little bit on the higher side. That's one thing. Dividends are not typically included in the return.
Okay.
And
So
dividends can be, 1.5% or 2%. So
Yeah.
that could be meaningful. And you typically have to hold them for the full holding period, which is typically a year, in order to generate the return that's projected.
Yeah, that sounds kind of like there's something called structured CDs that has a similar thing where you have a certain amount of upside of interest. There's also annuities, right? Indexed annuities can sometimes give you something like that. But I like it in ETF wrapper because it's in one account, right? You don't have to open another account for an annuity, and that's a straightforward way if somebody wants something like that with a little bit of upside, more than maybe you could get in a bond or CD, but also have some downside protection.
Yeah. So the first ones that sort of came out with that were Innovator Funds and First Trust.
Okay.
And but now there's several other firms out there which are also offering those, and investors need to do their homework. Typically, the ones we looked at, there wasn't really any credit risk because the options that sort of create the structure were guaranteed by the Options Clearing Corp.
Okay.
But some of these structures may vary somewhat, so investors
Yeah.
need to do their
So there
homework.
Could be a problem if the company had trouble there. So just getting back to the markets, like, from your perspective, where do you see, the opportunity right now? Maybe if you talk first about stocks and then maybe about the bond market.
Sure. So I think if you look ahead over the next several years, I think going back to foreign versus U.S. markets, I think there probably is some opportunity in foreign markets, which there hasn't been for some time. Or I should say there has been an opportunity, but I think we're now at the stage, especially if the dollar starts to really, if the dollar has peaked and is starting to decline, I think foreign markets may finally start to do a little bit better. I think if you look at large cap growth versus large cap value, I think you're going to see more stability between those two, more even performance. So, for example, adding something like the RSP, which is the equal weighted S&P 500, as opposed to the market cap weighted S&P 500, or holding those sort of more in combination, I think there's a better chance that will provide some get up and go for your portfolio
Sure.
over the next several years. Small caps right now, I think again we need to have lower interest rates, and you need to have a little more stability in global growth or U.S. growth for those to really do better. There are some pockets of opportunity as well. We used to use some thematic ETFs, but only in very small amounts to just provide some additional alpha in the portfolios.
Sure.
And they don't always work out, but when they do, that certainly can help. So, for example, artificial intelligence has been obviously widely talked about.
Yeah.
But I think looking ahead, instead of the companies that provide the picks and shovels, the companies that will actually implement it and benefit and see increased earnings and profits, those companies down the road will probably benefit. There are different ETFs that allow you to participate in that.
Some AI ETFs.
I think other areas like onshoring, for example, Trump is trying to bring jobs back to the U.S., which is something Biden tried to do as well. So I think onshoring, bringing jobs and companies and manufacturing back to the U.S., companies in that area will continue to benefit. Cybersecurity, unfortunately, cybersecurity and defense are two areas that are not going away, unfortunately, so those could provide some opportunities. The aging of the population, more and more people are approaching retirement, as we talked about. So people are going to be doing cruises. They're going to be taking education courses.
Yeah.
They're going to be new drugs that are developed. So I think there are a number of areas sort of geared towards the aging of the population that'll present opportunities as well.
Sure. Okay. What about in the bond market? Do you have thoughts on interest rates, where you think rates might be in the end of the year or 12 months?
Sure. I mean, that's certainly a tricky area, especially the last few days. It looked like the 10-year, for example, the 10-year Treasury yield was sort of range-bound between about 4 and 4.5, and we're now testing the upper side of that. There was a 20-year Treasury auction yesterday that doesn't get a lot of press because 20 years is not one of the main ones like 3, 5, 7 years, 10
Sure.
years. but it wasn't as well received. So that's always been a risk that because we have to issue so much debt, I think we have to roll over about $7 trillion in debt this year, which is a lot of money.
Yeah.
So we have to continue to find buyers for that. So if one of those treasury auctions doesn't go well, that could mean that interest rates will have to go higher to attract more buyers.
Oh, so that's meaning it didn't go well. There weren't enough buyers at the 20-year, or maybe not enough demand.
Right.
Yeah.
They look at certain, like in the bond market, they look at certain key metrics like the bid to cover, how many times oversubscribed the issue is. They look at indirect buyers, the international buyers, how much the dealers take down versus actual buyers.
Okay.
So when you take all those metrics together, the 20-year auction wasn't that great. And so it just made people a little more nervous about being able to finance all this, the $7 trillion in debt that we have to roll over. And so one of the things we did at our old firm for a majority of the fixed income assets, we basically purchased individual investment grade bonds.
Okay.
And we laddered those from about 3 to 7 years. And the benefits of that, first of all, you have to do your credit research. And that's important.
Yeah.
The goal was to hold the bonds to maturity, but there's always a possibility that something goes wrong with one of those names. A balance sheet goes wrong, a company's industry goes into trouble or disarray. But the benefit of laddering individual investment-grade corporate bonds is you know the yield to maturity and the cash flow at the time of purchase, and so that helps out when you're doing a financial plan.
Sure.
So I think that's one option that investors could do. But again, you do need to do your homework and credit research.
How many bonds would make up the portfolio generally? Or how many different companies maybe?
Well, that's important. So there was an approved list of about roughly 50 names or so.
50, okay. And these are all high quality.
So they were all investment grade bonds.
Yeah.
We tended not to buy anything below investment grade.
Sure.
And then if a bond fell below investment grade, we have to make a decision after doing credit research on whether to hold on to that bond or not.
Sure.
So there are other ETF providers which actually create ladders for you. For example, iShares or Invesco.
Okay.
The fees have come down, so that's another option for investors who might want to look into that.
Yeah. I mean, you could also, if you're a little less risk or more risk averse, you could use treasuries to do it, right? You could use
Absolutely.
CDs, right?
There are multiple treasury products. There are investment grade corporate ETF products.
Yeah.
I think they're also going to be more active. They're going to be more and more actively managed fixed income ETFs that will provide opportunities for investors in the future as well.
Yeah, and at a lower fee, right? Generally, that's compared to the mutual fund cousin, right, or alternative. Yeah.
Yeah, fees are coming down, which is positive for investors.
Yeah. Yeah, it is. It is. I mean, it's a great time to be an investor. I mean, there was a commercial years ago with Alec Baldwin, right, on SNL, Saturday Night Live, where someone's talking about investing and he's jumping out the window because the market's crashing, saying it's a great time to invest. So, it was an interesting, commercial, but the point is that fees have come down so much that it's really been great for investors. Brokerage commissions are zero at many places, so it's really helped investors keep more of their money.
That's a trend that's been in place and likely to continue, I think.
Yeah. So, is there any, we've covered a lot today. Is there anything else that you want to talk about, you think that listeners could benefit from?
Just a couple things. Just talking about some historical numbers might be interesting.
Sure.
Markets can be volatile from time to time, but trying to help from your perspective and at my old job, trying to keep clients in their seats during more volatile market conditions is really a main goal, and that helps clients hopefully stay on track to achieve their long-term investment goals. So J.P. Morgan puts out this thing called Guide to the Markets, which has a lot of great data. And one of the charts I look at every quarter is if you go back and look at all the S&P, if you look at the S&P 500 performance every year since 1980, in an average year, there's been a 14.1% intra-year decline at some point during the year.
Okay.
So that means that at some point during the year, the markets were down 14.1%.
On average.
On average.
Yeah.
In 5 of those years, at some point, they were down 30% or more.
Okay.
So that's a decent amount of volatility. But in 76% of those years, going back to 1980, the market finished positive.
76% since 1980?
Right. 76% of those years, despite the fact the market was down in intra-year 14.1% at some point, the market's finished positive 76% of the time.
Sure.
So despite the ups and downs in the markets do tend to rise over time. And so equities have proven to be a good long-term generator of wealth, but you just have to have the appropriate amount of allocation based on your needs.
That's right. And we've seen this year, I mean, we were down, 18, 19% at the bottom?
Yeah, we were
On the
down
S&P?
almost 20%.
Yeah.
Not quite, but we've made that almost all back.
We were almost back to even. We were even a couple days ago, I think, right? Maybe slightly up on the year.
Yes, on the S&P 500.
That's right.
It's hard to tell
Yeah.
exactly what's going to happen over the next few weeks, I think, for the markets. If you look at the data, if you look at the economic data, for example, most of the data has generally been pretty positive. In the economics field, we look at something called soft data versus hard data.
Sure.
So hard data are real data like unemployment, manufacturing, sales, things like that. And soft data are surveys, whether you survey individual consumers or businesses. And the soft data, the survey data has been really weak. And it's showing that I think the Conference Board's consumer index, which came out last week, was the second weakest since they've been doing this, which I think goes back to like 1960 or so.
Okay.
So it's pretty amazing.
Yeah.
So consumers are very concerned right now,
Yeah.
but they're still spending,
Yeah.
and generally the unemployment rate remains low. So I think what you're going to see is, because of all the talk about tariffs, consumers sort of purchased a lot of goods worrying that prices would go up.
That's right, yeah.
And so we're going to have a lot of inventory over the next couple of months, and maybe the economy might slow down a little bit as we digest some of that inventory.
Yeah.
So there could be a little bit of a soft patch maybe during the third quarter potentially, before things start to pick up again.
Sure.
And obviously we'll have to watch what happens in Washington between the debt, the tariffs, deregulation. Those could all be very positive things looking out longer term. But over the next few months or so, we'll continue to have some volatility.
Yeah, and it's looking like, the House passed the, I don't know what you want to call it, like the big beautiful bill, I guess, that President Trump was calling it. Essentially the extension of the Trump tax cuts and some other changes. So we'll have to see if the Senate approves that. So that could be good for the markets too, because there'll be certainty about what our tax rates will be for a while.
Yeah, I think that'll really help. And there's a lot of uncertainty. Businesses especially are holding off potentially hiring workers. They're holding off on new manufacturing plants and capital equipment because they just don't know what the rules of the road are.
Yeah.
So I think if that passes, and hopefully it will, which will be better for the economy, I think that'll provide more stability and potentially a much more positive outlook, which could be in 2026.
Yeah, definitely. Well, awesome. Anything else you want to add?
No, I think we covered a lot of things here. I wanted to thank you very, very much for having me on.
Yeah, it's a pleasure. I'm glad that we ran into each other at an event and we were able to do this. Hope to have you back on in the future at another point.
Well, thank you so much. I know you've done quite a number of these. I think they're chock full of great information, and so thank you very much.
Thank you. Yeah. So thanks again, Michael, for coming on. And as always, for anyone that has a listener question, you can head over to retirewithryan.com to click on Ask a Question to leave your question for a future episode. And I look forward to talking to everyone next week. Thank you.